Mortgage. My name is Imelda Ortiz.
I'm Geraldine Nina.
I'm Gwen Garza.
Gwen is joining us from Keller Williams, and we are here to talk to you guys a little bit about home buying. Feel free to chime in on the comment section. We promise we will get back to you after our live session. Leave your numbers and or details for contact if you guys want additional, if you have additional questions and you want a one-on-one consultation. So feel free to chime in. So in any case, we are going to get started because we feel that there's kind of a big need for people to know more about the steps on home buying, right? We always get asked, like, what's the first step?
Yes. Okay. So what would you think is the first step?
I would think looking for a house.
Wrong. No, actually, it seems like the first step would be to go out and start looking at a house, looking on Zillow, who knows what. Do not do those things. The first thing to do is to actually reach out to a lender and find out how much you're qualified for, because there is no sense in starting your search for your home to find out that you're not qualified for that type of home that you think. Like maybe you think you can afford a $500,000 home and you can actually only afford a $400,000 home. There's a big difference between those two price ranges, and it's kind of sad when you find out that you can afford less than what you thought you could. So the very best thing to do is to reach out to a lender like our friends here.
Yes, and I think the biggest concern for us, it's not that we don't want you to have fun looking at houses and or calling Gwen to take a look at some homes. It's just that we don't want you guys to be disillusioned when you look at a $200,000 or $300,000 home and your approval is only maybe for $190,000 or $225,000. You know, if we set the expectation up front as to how much you guys can afford, it will be so much easier for you guys to look for homes, and also for Gwen because it gives her parameters where she can show you homes, you know, what areas, what actual houses work for you. Maybe an HOA is just not going to work for your ratios as well. So we just want you guys to have a positive and reaffirming experience by knowing basically your limits first. Awesome. We're going to talk about approval. So credit and pre-approval. So basically when you come to us first, this is the first step, we're going to ask you super basic questions. Basically names, you know, how it appears on your social, your date of birth, apparently, or obviously your social security number. The reason is because that's all tied into your credit report. I know some of you have Credit Karma and other things that you see on your phones, and not all of them fit into what we pull. So a lot of consumers are usually confused as to, hey, my Credit Karma said I was at a 650 and you're telling me I'm at a 605. When you pull it as a consumer, it's very different than when we pull it. So the pre-approval process is the basic first step. Let's look at your credit first, and then we assess your income, and then we do what's called debt to income ratio analysis. How much of your income is going to pay in debts and your house? And we have certain limits that we have to abide by. So it's super important that you share those details with us. If there's something that maybe isn't on your credit report, like what are some things, like maybe child support doesn't show up there?
Child support doesn't show up sometimes. If you co-sign for somebody.
That's right.
If you co-sign a vehicle for somebody or any type of co-signature for anybody else, sometimes may not show up right away.
Some new purchases?
Yeah, sometimes when you purchase, those are kind of things that don't show up on a credit report, but you have to tell us about because it will come up at some point.
Yeah.
Underwriting usually will comb out those details.
Yeah, they always find out. They have their ways.
Underwriting is worse than FBI.
Yeah, right. So we really want to know all of the things that you're accounting for, also to help us with your budget. So we don't want to kind of overwhelm your monthly home budget. Mm-hmm. So it's very important for us as lenders to know, hey, and I also have daycare. Like my daycare doesn't show up on my credit report. But that's a huge expense that if I didn't tell my lender, they'd probably approve me for more, thinking we can afford this giant house. And what, I'm not going to put my baby in daycare? I have to work. So with that being said, there's a lot of things that you should avoid on your credit. Geraldine, can you tell us a couple of things?
Yeah, so one of the first things that most people ask about is, what am I not supposed to do, right? So first of all, do not max out your credit card. A lot of people like to get excited about the idea of being approved for a home and going out and looking at houses, and then they go and buy a stove on their credit, or they go and buy a couch or a refrigerator for a home that they do not own yet.
Yes.
So those are big no-nos. You don't want to go and max out your credit card. Don't make any large purchases that are unnecessary when you're in the process of buying a house, because that can definitely throw off your debt to income, and it'll just throw us out of the loop with everything. So if you do happen to make a large purchase when you're in the process of buying a home, you have to let us know right away. Another thing is, sometimes people like to think I can miss payments, or I can skip my rent because I'm going to move out anyways. So you don't want to miss any payments on any of your credit cards, on your rent, on your car. Do not miss any payments, because we get notified. So when you're in the process of buying a home, your credit is running. Is that how you say it? Your credit is running. We get an alert whenever you make any type of large purchase on your credit. Your lender will find out. So it's kind of disheartening sometimes when you think you have somebody and they're ready to go, and then they go and co-sign a car for someone, or they go and pull out something on credit from Best Buy, and then it just kind of throws them over the edge, and then we can't move forward anymore. So that's one of the things you don't want to do. And yeah,
I think the other thing that we see too is sometimes when you're really close, like here at Thrive, we can do loans for credit scores as low as 580. Of course, with additional rules, like the debt to income ratios are a little tighter, which means you can afford a little less home. Why? Well, because having a lower score makes it a little more risky. So mitigating that risk is lowering the affordability, right? They also want to make sure that you're not going too high over what you're paying in rent right now, so that, again, we don't put you at risk of losing that home. So I would plan to have a score of about 620.
Yes,
right?
Definitely 620. And the reason why also we like to kind of gauge it at around 600 or 620 and above is because of the DPA, the down payment assistance program that we have. So those programs require a minimum of a 620 credit score. So it's not Thrive Mortgage that requires that minimum, but the down payment assistance program that's available requires a 620 minimum credit score, and it's free money that's out there for people. And yes, it comes with a little bit higher interest rate, but again, because it's free money that they're giving you, you want to take advantage of that. But why not, right?
Think of it as like a stepping stone towards homeownership. So without this money, maybe you couldn't get into the home, but you might not need it forever. Let's say you get DPA, which today the rates were about 6.25% to 7%.
Yeah.
And in 2 years, let's say you're doing so much better financially. Maybe you've gotten a raise, maybe your house is appreciated in value. Gwen can help us with a current market analysis at that point, just to see and gauge where your house is on, on its value, and then we can refinance you for a lower rate. So you don't have to keep that rate forever. Again, think of it as kind of like a stepping stone towards homeownership. Once you access homeownership, you're in. Like, nobody's going to take you out of your house unless you foreclose, and we're here to help you, not have that happen. But that is going to be your access or your key to homeownership. Once you're in, again, refinance can be the answer, or you keep that rate for a while and then refinance when the time is right for you. So that being said, a lot of the times where we kind of trip a little bit is when we have to look at your income. We can count base income, which is hourly, bonuses, overtime, sometimes differential income for nurses or people that work overnight shifts, things like that,
and stuff like that. Yes,
we can count those
continued
for 2 years.
Yes.
Perfect. And other times it's self-employed income, and that's where sometimes we get tripped up. So since Gwen is the business owner as well, we would like her input on business income.
Okay, thank you. So as a business owner, you have a different type of income tax that you file, because you have either your 1099 employee, or you are have a business and you get K-1s from your accountant that tell you about your income. So in these particular instances, when you are self-employed, it is very important when you decide that you want to purchase a home, that, or any kind of loan for that matter, that you are showing your income and expenses in line with what that should be. So that way you can actually prove that you have an income instead of reporting a loss. So a lot of business owners try to, report not as much income. I don't want to say that they're trying to be fraudulent or anything like that, but of course you're trying to avoid having to pay a lot of taxes. Mm-hmm. Well, if you want to show that you're having income, you're going to have to pay some taxes. So you need to run a very lean expenses during the period of time that you're wanting to, prior to the time that you want to make that purchase, whether it's for a home loan or another kind of loan, you want to make sure that you're running a tight ship. And by that, it means that you're going to be limiting your expenses, making sure that any expense that's running through your business is an actual business expense. Trying to have a completely separate account that the money goes into and comes out of for the business, and not commingling your money from your personal money with your business money, because that's where a lot of times things get real fuzzy, because you're running your home expenses, your personal expenses through your business account because, well, it's your business. And you can do that. Mm-hmm. I mean, that's one of the nice things about having a business, but it's a deterrent when you go to apply for a loan, because here you ran through all of your expenses, a bunch of meal expenses or a bunch of household expenses that you're running through your business. Maybe you're paying your vehicles through there, or you're paying your utilities from your house through there. I don't know. You're being very lavish in your spending, and your income looks very low. So when they run it, your P&Ls are not looking too great. So you want to make sure that you try to run those expenses as tight as possible that are actual business expenses, so that way you can have a higher amount in your income that you're making in your profit. And that you need to do that for 2 years. So that way you can have a good income coming in for 2 years before you're ready to purchase that house. So that way you can be prepared for getting the most money for what you're actually earning. Because when you're self-employed, you're making that money yourself, like you made it, right? It's your business. So you might as well take advantage of that, but that's kind of a downside. So you need to be prepared for that. So if you're thinking like, you know what, 2 years from now or 3 years from now, 5 years, who knows? I would like to purchase a house, and I am self-employed. My husband and wife both work there. It's our sole income. You need to plan now for what you want to do in your future, whether it's 2 years, 3 years, 5 years, whatever. Plan now so that way you can have that income justified when you're ready to go.
Yeah, and it's good that you mentioned the 2-year mark, because even though I know that everybody's heard that we can average income for a year, mm-hmm. It is very rare that we get that as an approval. Like, you have to have like the trifecta of goodness. You have to put a huge down payment, you have to have high credit, mm-hmm. and your business has to have been established for years. So sometimes, just sometimes, we get the perfect kind of combination of everything where we will be allowed to only look at 1 year's tax returns. But I would say for most people and for the general public, let's just be prepared for the 2-year average. So let's say, for instance, last year you filed taxes and you made $250,000 for your business, but then you filed all of these expenses, and we understand businesses are expensive to run. So we don't blame you for putting all those, deductions in there. But on the bottom line, your taxable income was only $12,000. Let's say this year you decided, okay, I know next year I'm going to buy a house, I'm going to put $50,000. You would think that we're going to average the $50,000 over 12 months, but essentially we're adding the 50 to the 12 and averaging it over 12 months. It's very difficult sometimes for us to explain to clients and for us to all face reality that unfortunately the affordability is not there. We know that your intake is about $5,000 a month, but we just can't count it because we can't prove your taxable income. Mm-hmm. That's not to say there's not other programs like the bank statement loan.
There is, luckily we do have those niche programs, where certain customers, clients, they have certain requirements, but those programs also have different requirements as well, such as income. You have to have a
12 months bank statement.
12 months bank statements, certain credit.
Yes.
And again, that money has to be going into your bank account. You can't just bring me a 12 months of bank statements and none of your business income is going in there. Does that make sense?
Yeah.
So we kind of have to see that you're making money, like
Deposit.
And large down payment.
Yes,
So
that
a
usually
large
stops
payment is a very large down payment.
Yeah, because you're trading one for the other. So I don't want you as a lender to look at my W-2s or my tax returns or my 1099s. I just want you to look at my bank statements. Well, in turn, that specific investor is going to look at the bank statements only over 12 months, average it, give you fantastic affordability, but they are going to ask for between 10 and 20% down.
And higher interest rates as well, because it goes back to what you were saying about it's riskier. They're not checking all these boxes. They're only looking at your bank statements. So obviously you're going to get a higher interest rate because, it's riskier that way. They're not looking at anything else. So
yeah,
you get a higher interest rate with those. So it's better to kind of just have your paperwork in order in the long run. 2 years seems like so long.
And the snap of a finger, it's here.
Yeah, and that's actually, in reality, you're getting a home loan for 30 years. So 2 years is nothing when you consider that you're actually borrowing the money for 30 years. Now, are you going to have a loan for 30 years? Maybe not, but maybe not in this day and age. That's not something that happens anymore. Like, maybe our parents and grandparents used to actually live in one home forever. Yeah. But, you are applying for a 30-year loan. Mm-hmm. So a sacrifice for 2 years is not that big of a stretch to have a forever home.
Yeah, and sometimes I feel like whenever we do these loans, people can get a little exasperated because they ask for more documents or they give you what's called conditions. So pretty much everybody that we approve, any company, you get a conditional approval. That means you're approved, but, right? Dot. So there's a list of conditions, and some people might be super squeaky clean files where we have maybe 5 to 10 conditions, and other are, honestly like normal files, which are between 10 and 20 conditions. Some of them we take care of on the inside and you never hear about them. And some of them will be asking for your help. So just be patient if you're approving for something that's not, your vanilla kind of, loan, like conventional, FHA, VA. Those for me are vanilla. It's when we start getting to stated income, bank statement, those are a little quirky. And because again, like Geraldine said, they're a little riskier. They're gonna ask you for more things. So
right. And keep in mind that you are asking somebody for $200,000. Hey, I don't know you. But will you give me $200,000? But come on, you gotta show something. Yeah. Like we go on a date and ask for more than that. Like come on.
I'm gonna credit report on you to be on a date.
You should. Like, and if any of you ladies out there are going on a date, call these ladies. Yeah. Let's run a credit report on your man.
If you're not married, call us first.
Come on. We can hook you up. We can hook you up. Like, let's make sure. Those should be dating questions, honestly. Like, hey, what's your credit score? Yeah. Hey, what's your income? How long have you been employed? Yeah. Like, these are important things for guys and girls. Because honestly, that person that you fall in love with could be what is holding you back from getting a home.
Yes. And I'm not embarrassed to share because I know my husband's probably watching. When we, became serious, I checked his credit score before we got married. It's because I am in finance and I think about this all the time. Yeah. And to be honest, I am super grateful that we were both transparent with each other. They say, and they've been saying this since the beginning of time, finances are the number one cause of divorce. Wouldn't it be nice to just check that box off before you sign on the dotted line, knowing what
you're so lucky. My husband and his law enforcement brothers check my criminal background. Thankfully, I passed. We didn't get married. I passed. I was not a criminal. So, my credit score would have been nothing compared to having them scope through my criminal background.
So I think it's a fantastic idea to check people's scores before we dive in.
Or at least have a plan in action. If you don't have the credit, you know, if you don't have your credit where it needs to be, if you don't have the money for a down payment, at least have a plan in action. And the best thing to do to get a plan in action is to talk to one of us.
Yeah.
Talk to one of us. You may feel hesitant right now and be like, you know, I don't want to call them because I know my credit is not great.
Mm-hmm.
But the first step is making that call and getting advice from professionals who know about credit, who know about finances, because the longer you delay putting that call off, the longer you delay putting yourself into your dream home.
Yeah, and just to quickly kind of wrap up on credit, I think you guys, if you look at this like any other profession, like for instance, again, I will overshare on this video, or on this live. Right now I was telling the ladies, I need to set up an appointment with the dentist because I think I have a filling that came out because my tooth is killing me. I am not embarrassed to go to the dentist and tell him, hey, I think something came loose on the filling. Because he looks at teeth every day. I know my doctor, he's fantastic. He's not going to judge me because my filling is coming loose. Seriously, like Gwen and I, Geraldine and I look at credit all the time. Yeah. Think of us, you know, again, as your, you know, fix-it specialist. We are here to look at it in a neutral way. This is a neutral setting. This is a no judgment zone. Nothing defines you as a person, especially credit. Things happen. You know, credit happens to good people. Collections happen to good people, especially medical.
Yeah. And it's repairable.
Yes.
It's repairable. You
Absolutely.
can fix it. There's, I mean, very little that you could possibly do to your credit that you couldn't repair within, you know, some are going to take longer than others. But you can fix it.
Where there's a will, there's a way. And believe me, we have the ways as long as you guys are willing. So that kind of wraps up on our credit spiel. We want to talk about some of our favorite things like finding a home. So we will let Gwen talk about the fun stuff.
Well, that is my favorite part, is finding the home. And I love to look for homes. I love to help find you the perfect home that you're looking for. So, of course, after you get the approval from your lender and they say like, okay, the next thing is, what is the magic number? What are we looking for? What's the number? What can we work with? So, of course, we didn't kind of mention this, but in the number, like just because you're approved for $200,000 doesn't mean that you want to spend $200,000 on the home. So that's my job for me to find out, what do you want to spend? Like maybe Imelda and Geraldine tell me that, oh, they're approved for $200,000. Well, you tell me like, look, I really don't feel comfortable with a payment of that amount for $200,000. I would feel more comfortable with a payment that's in the $175,000, $150,000. Great. We are not going to go and look at homes that are $200,000. Just because you're approved for a $200,000 home, but you're not comfortable making that payment, we're not going there. Yeah. We need to stay where you feel comfortable. So let's start looking at the homes that are from 150 to 175, and that's where we need to stay. Because the payment is what's so important right away. So that's what we're going to look for. We're going to look for the homes that are in your budget. And then we're going to start trying to figure out, like, are we looking for a fixer-upper? Are we looking for completely ready to go, no, nothing is needed kind of home?
Like new construction?
Even new construction. So something that I don't think that everybody knows is that realtors are very helpful when it comes to new construction. Because when you go to a new construction, you need to keep in mind, any house that you go to where you do not have your own realtor, the person that is there, whether it is the person on the sign or the person that has the shirt with the name of the people that built that house, they are only interested in selling that property for that seller. They could care less that you are only looking for 150 to 175. Yeah. They don't care about you, and their due diligence isn't to you. It is to the seller, whether it's a new construction or it's a pre-owned home. So you need to be mindful of that. Don't think that I show up here at this house over here and I'm going to call the name on the sign because I'm going to get a better deal. It actually does not work like that. They work for the seller. So when you call them and you tell them like, hey, well, it's because I am approved for $200,000, but I really would only like to pay $150,000. They're going to tell the seller, hey, they're approved for $200,000. And this house is for $205,000. Don't go down. They have the money. They can buy it. Don't do it. And then they're going to tell you like, oh, don't worry. Like, let's go ahead and put the offer, whatever. Like, not to say that they're going to be unscrupulous or anything like that, but their obligation is to the seller. So the reason why you need a realtor that is for you, for the buyer, is because if you hire me to work for you and I am not representing the seller, I represent you. So whatever you tell me, I hold in confidence. So I go to the seller's agent and I tell them, like, hey, my client would like to offer X amount, and they maybe it's a little bit below what they're asking. Well, I'm not going to tell them that you're approved for more than what they're asking. They're not going to know that, because that's going to be privileged information between the buyer that I'm representing, and we have to have a buyer's agreement and in writing that that I'm representing you and I work for you. If I do not have that and I take you to a house, I work for the seller.
I didn't know that.
Yes.
I didn't know that either.
Yes.
That's
I
good to know.
technically work for the seller. If I do not have a buyer's agreement with the person that I took to that house, I work for the seller.
Is it because you access their home?
Well, because I don't have an agreement with them. So
Wow.
I work for the seller.
So it's important, you guys, to sign
Very
that
important.
agreement.
Yes, it's very important that you get that buyer's agreement, because for more than one reason. Like, maybe you start looking at resale homes and you need that. When you go to new construction, the reason why you need that also is because that representative that's there representing the new construction, they work for the builder. They do not work for you, and they are trained to sell, sell, sell. They are hard salesmen. Like, they are kind of like going to the car sales place. They are going to get you into this house. Like, that is what they want to do. They are very good at their job. So you're working with a skilled salesperson that is not looking after your best interest. And you may not know this, but a lot of new construction properties, the price is negotiable.
Oh.
You can negotiate a lower price.
I
You
feel
do
like I
not.
should have had a bell or something.
I know.
Like, that's like, wow, that's really good information.
You do
Yes.
not have to pay the price that they tell you. Like, they have a flyer. Here's the flyer, and it says price is X. You don't have to pay that. You can offer less on a new construction.
And they may be willing to negotiate.
They may be willing to negotiate.
But we don't know that as consumers. That's why we need
Right,
you.
that's why you need a realtor, because we can help you with that. We are used to negotiating sales prices with sellers, with their agents. So that's what we do. And we know how much homes have sold for. We also know, in some aspects, new construction. Because sometimes when a new construction sells with a realtor, they upload it into the MLS as something that's called sold non-MLS, and they will disclose in there that only realtors know the amount that house sold for. So even new construction is in there.
Wow.
Because we get recorded on our sales and things like that. And so sometimes, and in a lot of cases, when a realtor represents a buyer, they will upload it into the MLS, and that way we can see. Like, oh, you know what? This home over here was sold in the San Isidro area. It's a new construction. I saw it on there. It went in, and they bought it for X amount, and they're telling us this is the number. I know that number is not necessarily the bottom line for them. Mm-hmm. They will negotiate. Now, will they always sell it for the lower price? It's a negotiation. Everything in real estate is negotiable, right? So just so you know that, even new construction. So it's good for you to have a realtor on your side, so that way we can go into the new construction and represent you and only you.
How about the inspection process, Gwen? How does that usually go?
So once we find the house for you, you're like, this is my house. I want this house. So you pick that house, and you go ahead and you put the offer in. The offer is accepted. Now, once your offer is accepted, you have an option period, and your option period can be any number of days. I've seen 3 to 15 days. It could be anything. The typical amount is somewhere between 5 and 10 days for your option period. And option period means that you pay the seller a fee, which can be $100 to $1,000. It just depends. You pay the seller a fee to give you that time of doing your due diligence for that house, which means that during this X amount of period of time, I'm going to give you $100, and during this time, I'm going to hire an inspector to come in here, look at the house, make sure that there's nothing wrong with the house. and tell me if there might be some things that I need to get further inspected. Like maybe there's something wrong with the roof. Okay, now we know there might be something wrong with the roof, the plumbing, AC. Those are the 3 huge things that could be wrong with your house, or maybe your foundation. So these 4 things, you know what? The inspector comes in and says you should look further at the AC, look into the plumbing, look into the roof, look into the foundation. If somebody tells you all 4 of those things, you should probably just move on.
Walk away slowly.
I would suggest you move on. No, I'm out. But anyways, should you pursue that and continue on, then you should find somebody that is an expert in the foundation, an expert in the AC, expert in the plumbing, and an expert in the roofing. That way, they can come in and really dive into that problem and tell you, this is what I feel, this is good, this is bad, and give you that information. That way you can know whether you want to move forward or you want to ask for repairs, what you want to ask for in that process. So you need to know that before you move out of that 10 days or whatever your option period is, because in that period of time you can back out completely.
Nice. And get that deposit back.
And get your, not your option money, but your earnest money. You can get your earnest money back, which is about 1% of the sales price.
Nice.
So you can get that money back. After that, it's a little bit sticky trying to get that back. It depends on, there's more limitations as to what can happen for you to get your money back.
I'm glad you touched on walking away, because it reminds me of my good friend back in Portland. When she was first buying her house, I remember she came to me, because I was working on a nonprofit at that time, and she comes to me and she goes, I really like that house because it's yellow. And it's my favorite color. There's just this little problem of a little dry rot. And her realtor said, there's no such thing as a problem of a little dry rot. The dry rot happened to be in the entire bathroom. But remember that this is an emotional thing too. Your realtor is there to separate you from an emotional disaster. Don't buy based on emotion. She's also the buffer between you and you making a mistake. Like mold, dry rot, any of those things have to be mitigated and taken out of the picture before we can fund the loan. Right. These are things that are for your health and safety. FHA even has rules about health and safety issues. Yes. So we are here to protect you from making those kind of investment faux pas.
Yes, and sometimes maybe they can make it through the appraisal and it's not something that's a red flag to the appraisal, and you do get the loan. And then now here you are, you're the homeowner of this house that you were given this list of all these things that are wrong with the house, one of them being maybe the roof, and or the foundation, and now you file a claim with your insurance and they tell you, oh, do you have an inspection report? And you give it to them and it says on there, oh, the roof was bad, it needed to be replaced.
Oh, great.
You said you knew when you bought this house this. So this is a known defect of the house. We are not going to cover it on your insurance.
Oh,
now we're talking roofs are very expensive.
What do they run these days?
We're talking, it depends on the size of your house, but you're looking at anywhere from $8,000 to $30,000.
Oh my God.
And now if this roof is not covered on your insurance, you are in a world of trouble, because how are you going to come up with the money to pay for that? Because you probably just gave all of your savings to your down payment for your house, and now you find out that you have a roof that's leaking. It could affect your entire house. So it's important for you to pay attention to your inspection. It's important for you to follow up with those things. When the inspector tells you that this needs further investigating, or you need to seek information from a licensed whatever, you need to do that, because that's why you pay for that. You're paying like $300 and something for this inspection. Why are you might as well just not do it. If you're not going to listen to anything on here, like don't do it. If you're not going to do it, just throw caution to the wind and just be like, whatever.
And that leads us into kind of the next topic, because sometimes you don't find out in the appraisal, you find out or the inspection, you find out to the appraisal. I remember the first house we put an offer on. Fantastic house, of course, emotionally, I was attached to this house. Already planning my daughter's quinceañera pictures in there. Terrible thing to do. But I loved it. And I found out, not during the inspection, we had already sunk in the money for our earnest money, for our option period. We did the inspection, everything looked fantastic. You know, I mean, the house was outdated, but nothing big. Then comes the appraisal, and it tells us it's in a flood zone. Yep. So that's an extra amount per year. I think for us, the quote was like $2,200 a year for flood insurance, because it was in Hillside. Not all houses in Hillside are in a floodplain, but ours happened to be right in the middle of the path. So that's when we pulled out of the transaction. And lucky for us, we didn't, lose our earnest money, but it was a terrible feeling to be this emotionally attached to a house where I had planned parties in my future and I had seen myself living in there. And so we had to give it up, but it leads me into the offer and appraisal process. So like Gwen said, your offer's accepted. We send a big congratulations. We're super excited. You do the inspection, you have
Let
a
me
list.
stop you.
Okay.
Something we didn't mention.
Oh.
When you place an offer, you need a letter from the lender.
Oh,
yes.
yes, that's us.
It is so important. You are not going to get an offer accepted without this letter from the lender. And even if you're going to pay cash, and this is something that sometimes people are like, well, how dare you ask me for my liquidity? It's not me. I don't care. Like, I believe you. I believe that you're as rich as you tell me you are. But this person over here that's going to accept this offer, they don't believe you. I'm sorry. They don't know you. They need to see show me the money. So whether you're paying cash, you can't just get away with saying like, I'm just going to pay cash. Because sometimes people try that. They're like, oh, I'm going to pay cash. I don't need a lender. And then you're like, how are we going to pay for this? I'm going to need a lender.
That's where you come in.
Yes, exactly. So even if you pay cash, you need a letter from your bank that has the cash.
Yeah.
Saying that you have the cash. You need that. So no matter what, when we submit an offer, we have to show where is the money coming from. This is why you start with the lender. And sometimes your realtor may ask you, show me the money.
Yeah.
If you tell me that you're going to pay with cash, I need a letter from your bank, wherever you're going to get this money from. Sometimes people say, well, maybe they're the heirs of this company or something. They're like, well, my family's business is going to pay for it. That's fine. I don't care where the money's coming from. We just need the letter from that place, wherever that money is, that it is going to be used for this particular transaction. Because if you want your offer to be taken seriously, it has to go together. They go in together, they look at it. And the other thing about those letters is the lender matters. If you're working with a lender that has a bad reputation of not closing deals or of, some weird things, believe me, they happen. Some realtors look at that and they will tell their client like, hey, we have these two offers. This one's from this
Online lender.
This online lender, and this one's from a local lender, and this one's from a bank.
Yeah.
A big bank. Let's just say
No names.
one that you have like a huge credit card with.
Yeah.
Let's just say one of those big banks that are in every city. Okay, so if you're looking at these three offers, and you have the online lender, you have the big bank, and you have the local lender. The realtor's going to be like, look, and it's Saturday at 5:00. There's no way I'm going to talk to this online lender. It's probably not even a real person. This bank, I probably won't even talk to them on Monday.
Yeah.
It could be Friday, maybe, before they give me like a letter saying they'll get back with me in 24 hours or 48 hours or whatever.
Mm-hmm.
So what do you think they're going to do? Most likely they're going to go with the local bank because they know that they can pick up the phone with that local, not bank, mortgage lender. They can pick up the phone and they can call them. And it may be Geraldine or Imelda, and they can be like, hey, I have so-and-so over here. They put in this offer. And how solid is their file? And then we'll tell them like, hey, you know what? We already checked all their income. We verified all these things. They're solid. They're good to go. Okay, all right, fine. They're going to be like, you know what? And say they were all the same number. All of them were exactly the same number. The one that they're going to go with is the one that they were actually able to verify and able to speak to. And that goes a long way when you're working with a multiple offer situation.
Mm-hmm.
And the only thing that would beat that would be cash.
I think that, like, honestly, like, the word of the day today should be vetted. Sponsored to you by the letter V. Vetted is the word of the game here. We are vetting you as lenders. You are being vetted with your credit score. You are being vetted with your W-2s and tax returns. Now with the offer, we've vetted you already. If it's a cash offer, they're vetting you with your bank. So you're just being vetted the entire time. We want to make sure you're a real buyer. You're not wasting our sellers' time, and also you're not wasting your own time. Like, what's worse than, going out there looking at houses and you really haven't been completely forthcoming about your situation. It's not great for you as a buyer. And honestly, that's not a great way for us to represent you. So I'm happy, as always, when a listing agent calls me and asks me, because I can't wait to tell them, I've looked at I've got eyeballs on documents. I have looked at everything. I know these guys have their down payment. I have looked at their credit report. I know they are solid. Like you said, we can go ahead and close. So, and I know my listing agents love it when I have actually looked at everything. So I have physical documents ready to go. So again, it takes us to the offer and appraisal. Your offer's been accepted, like Gwen said. You've gone through the inspection process. Then she gives us a holler, usually sends everything to title. They also talk to us and they're like, hey, PT Dubs, your client has been approved for this house. You guys need to move forward. At that point, Geraldine and I are, quickly disclosing your file, which means that we're sending you docs that basically in a nutshell say, yes, I am moving forward with this loan. I am the one that applied for it. I certify everything is true and I authorize you to move forward. We have the intent to proceed. Super important for you to sign those documents because it basically gives us the green light to order your appraisal. The reason the appraisal is so important is because it's going to tell us the value of the home. So the inspection is the bones of the home. Is the home safe for you to live in? Is the roof, does it have a lifetime or the life expectancy that we need for the loan? So all of the things are good with the inspection. Now the appraisal is how much is this house worth? Because as a bank, we don't want to lend you more than what it's worth. Now you always have the option, and I have seen this happen, of paying the difference. Let's say the appraisal comes in at $200,000 and you offer $215,000. You can pay that $15,000 out of pocket. We will not say no to that. We just won't invest as a lender more than what the house is worth. So the appraisal is usually what can make the file go a little slower or, make us lucky and the file go a little faster. If you had talked to us a couple months back, appraisals were really backed up. I'm talking maybe 3-4 weeks. If it's a VA, it's a little crazy because we have a very limited number of appraisers here in Laredo that do VA. But for typical appraisals, I am seeing between 1 and 2 weeks, depending on whether you want to pay a rush or not. Now, be prepared to pay for that up front. So you're going to pay anywhere from $500 to $750. And let's just say, for learning's sake, that there was a CO detector missing or, the water heater wasn't strapped in, the burglar bars were not removed. It will not pass the appraisal. If you know you're going to do an appraisal, have them remove the burglar bars. Make sure all of your smoke detectors and CO detectors are in working order. Make sure your water heater is strapped in. Try to mitigate the losses because otherwise our appraiser has to go back. And guess what? They charge you again. It's usually what, $150?
Depends on the appraiser, but about $150.
And it can delay it like another week.
Yes, so we don't want to do that. Now, where do we expect that to happen? On new construction. Because usually we send the appraiser before it's even fully built.
And I just want to point out quickly that appraisers are a third-party company.
Yes.
We do not have control over appraisers or their schedules. That is something that we request, us as a lender, but we have no control over when.
We don't talk to them.
And we don't talk to them. We don't even know who it is until after the appraisal has already been turned in. So that's, of course, yes, get as much of the repairs out of the way as possible from the beginning to avoid having to have a reinspection later down the line, and then that delays it like another week or 2 weeks, and that's you not going into your home.
Yeah. Now the appraiser can also issue a set of what's called needs list, like maybe they put on there that your CO detector needs to be fixed, you need extra smoke detectors, whatever the case may be, and that will stop us from closing.
Yes.
So we need to make sure we pay attention to that appraisal report. So with that, from there on, we do the appraisal. Let's say we have the appraisal back. After that, we send your file, or in the meantime, we send your file to underwriting. And I'll let Geraldine talk about that while I fix my phone.
Before we move to underwriting, I want to address the appraisal thing, the appraisal gap. So this is something that's happening, especially in this market that we're in, where there can be an appraisal gap. And an appraisal gap is where the house, you made an offer of $200,000 and the appraisal comes in at $195,000. So now maybe the seller is going to refuse to sell the house for $195,000.
Yes.
They want $200,000, which is fine if you have the extra $5,000, but you have to come up with your original down payment that they had told you. Like, say your down payment was $8,000, and now you need to also have the $5,000 on top of it. It's not like you are gonna I'm good because I'm putting $8,000 and now I have this gap of $5,000. No, it's additional.
Yeah.
It's additional $5,000 on top of your already down payment, and that's not including the closing cost part. So we didn't really touch on any of this, which I guess we can talk on that on the next one.
Yeah.
The closing cost, the down payment, and then an appraisal gap those are three different numbers that can come into play on what you finally need to bring to your cash to close. And
because not every seller is willing to give closing cost concessions. Right now, the market has been pretty hot for the last, I would say last year and a half.
For sellers not paying anything?
Yes, and they wouldn't come down on the price. Not only would they not come down on the price, but, they were getting overpriced, over asking, no concessions.
No concessions,
So-
waiving appraisal.
Yes,
So
waiving appraisals.
the buyer has to be prepared to bring in all that money, the appraisal gap, your closing costs, and your down payment. So all of that adds up, and that's part of underwriting. Part of getting approved in underwriting is having sufficient funds to close.
Right.
So if you're not able to provide evidence that you have sufficient funds to close for all these exceptions, which they might not happen all at once. You might not have an appraisal gap. You might not have to have a reinspection, but being prepared financially and showing the evidence that you have the money to pay for your down payment and your closing costs at least is part of underwriting. Another part of underwriting, like I said, is that they constantly monitor your credit. They double check your employment. So we have to have a 2-year history of employment or transcripts.
Yes.
School transcripts count as
re-verifying.
At the very
At the
end.
very end, it's
Absolutely.
re-verifying the income, re-verifying the bank statements.
the day before
Re-ver-
closing.
yes.
Don't quit your jobs, guys.
Don't
And
quit your job.
change jobs.
Don't
You're
quit your
not
job.
free.
Don't
You're
change your
not
job.
free as a bird.
Do not go and max out your credit cards or make any purchases the day before closing just because you think you've already reached the finish line. Do
No.
not. Until you get the keys to your house after you've signed that title is when that
Don't
house
do
belongs to you.
anything. Yes.
Because we have had files where we're clear to close and then they go and buy a refrigerator and that sends them over their debt to income, and so that just that kills the deal completely.
Yes.
But yes, for sure in underwriting we are looking at employment again the day before closing, your credit and your funds.
And they ask you a ton of questions in underwriting, a ton, where you're like, what is happening? I went through all of this at the beginning of 2 months ago. Why are they asking me all this again? Because they are re-verifying that everything is still legit. Like, don't worry. And people will say, I don't think it's gonna happen. It's gonna happen. But just be calm,
Cooperate.
answer
Cooperate.
whatever they ask, just provide it. Like, don't think that this means that they're questioning you or they don't believe you. Like, they believe you. They just are verifying. Once again, you're asking for their money.
Yeah.
They're gonna
You're
make sure
not like
just
you're.
letting-
you are who you. They're
Yes.
gonna make sure you are who you say you are. You're the person that you're claiming to be. You have the money you say you have. You have the job you say you have. They want to make sure of that, because if not,
Just verify
they're not
everything.
gonna give you any money.
Exactly. If you were gonna give somebody $200,000, you would do the same thing. You would be like, "Who are you? Do I even know you? You look a little,
How likely are you
sketchy.
to pay?
You look a
Yes.
little sketchy. Like, I don't think I know you anymore. Like a month ago you did this and now you're telling me that. No.
So we want to make sure that you guys, again, are vetted. I think that's
Yes.
the safe word to use here. Vetting is 100% underwriter's position. For those of you that are visual learners, I like to think of this as a puzzle, right? Gwen brings us the puzzle piece. Okay, that's her job. She brings us the client with all of their puzzle pieces, which is their job, their income, their savings. Mom and dad are going to donate funds for the down payment. All of these puzzle pieces are kind of put on our desk.
And
Geraldine and I put the pieces of the puzzle together, right? Sometimes some pieces are missing, but we still are able to move it forward. Then our processor takes the puzzle apart and puts it back together for herself to make sure that we didn't miss anything or that we didn't jam any pieces that didn't belong.
Yeah.
Then the underwriter takes the puzzle again one more time and destroys it, like obliterates it, puts it back together with duct tape, spit and grit and everything else.
Yeah.
And then they give us the seal of approval, which is our clear to close. That's really what we're all getting to. It's our end goal. All of us are here to cheer you on through the process. We just want to make sure those pieces fit, and that's underwriting in a nutshell.
Yeah.
And yeah, Geraldine's right. They're worse than the FBI.
They're worse than the FBI. Honestly, I say that all the time.
Yeah. So then we get to our clear to close.
Clear to close. Yes. So once we get to clear to close, basically what happens is there's this magical person behind the curtain called the closer. And nobody knows who the closer is. No, I'm kidding. Yes, we know who the closer is. Thankfully, when you work with a company like us, we have direct contact with the closer.
Yes.
And so there's a closer on our end on the lender side, and then there's a closer on the title company's end. And basically what happens is they get your file, right? And they go over all your fees, and they do what's called a balancing of your fees, right? Of your file. And so our closer on Thrive Mortgage side and the closer on the title company side will go back and forth and just exchange fees and documents and make sure, is this what you have? Yes, this is what I have. Is this the same fee? Yes, this is the same fee. Did you charge them for this? No, I didn't. And until they balance, which means they match up to the exact amount that they both have the same exact amount on each side. So once that happens, we contact the borrower and we let you know this is the amount of cash to close that you need to bring. And usually that'll be about a day or two before you're actually closing. And so then you would get prepared to, ask for the day off from work, go to the bank and get your cashier's check or wire the money to title, whichever preference you have, and then show up at the title company. And again, you're not going to do anything until you sign those documents. When you sign the dotted line, that house belongs to you. And we get the keys.
Not necessarily.
I'm sorry, yes, I missed the part. Until it funds.
Yes.
Until it funds.
So right. So when you sign, you're still waiting, of course, for the seller and the buyer both have to sign. A lot of times now there's a mobile notary involved. So we're talking about signing in another city, another state.
Yeah.
So there's some little things that sometimes happen. And then there's timing also. So depending on the time of the day and the type of loan that you have, some loans fund at the table, some loans fund that day, some loans will fund the next day. And fund means, when are we giving you the money? Here's the money.
Yeah.
And when the seller gets the money is when you get the keys.
Yes.
So when the title company says this loan has funded, that means that you are allowed to get the keys. So that's the magic day. Like on closing day, the realtors are like, has it funded? Has it funded?
Yes.
Has it funded? Like,
They're
when is
eager.
funded?
They're eager.
When is the funding? Yes, it's funded. Okay. And Friday's funding is crazy.
Yes.
Yes. And end of the month funding
End of
is
the month.
crazy.
This week is going to be a little crazy because it's a holiday weekend, and we're in the middle of the end of the month, and it's a holiday week, and there's a lot of
Be
things
kind to
happening.
your lenders
So
and your title people.
things happen. Like maybe the buyer can't sign, and the seller does sign. So the seller's like, "Where's my money?" Well, only one of the buyers signed, or not both of the buyers
But
signed.
the signatures didn't match.
Yeah. So there's a lot of things that can happen at title that can kind of slow it down a little bit, where you think that, oh, I want it to fund on Friday so I have the weekend to move. Well, we would like that for you, but it doesn't always work out like that because
Yeah.
some of the title companies, they have a 2 o'clock deadline, some of them have a 3 o'clock, some of them have a 4 o'clock. Some of them just make up a deadline.
Jackie, you wanted to chime in and say something?
No.
Closing?
No. I think I'm okay.
So then at that point, when it is funded and we can give you the keys.
Yes.
So if we represent the seller, well then we'll give the buyer's agent the keys and then they will give you the keys and not until the funding.
Yes, and we keep your realtor in the loop. As a matter of fact, they always get an email and text saying, hey, your loan is funded, congratulations. That's when we know we can all high-five each other like the penguins of Madagascar. We are just high-fiving each other like crazy and celebrating because we finally got you to the finish line. We understand that this is a humongous commitment, not only to yourself, but to your future. You're making a giant investment in your future. Next to your education, this is the biggest investment you'll make in your life.
Yeah.
So we are here to help you with that. We understand that. We know that there's fears behind it. We're here to help you and support you every step of the way. We have a full team here. So Geraldine is a full-time loan officer. So am I. Gwen is a full-time realtor. This is not a side gig for us. This is what we've dedicated our careers to. I've been doing this since 2006. Gwen has been in the business for a long time too.
Since 2001.
Yes, so she beat me out of it. Geraldine as well. So we all have the history behind it. We've seen the ups and downs. Yeah, we've seen the interest rates go up and down. I was just joking around with a client the other day. These were the exact interest rates that were in place when I started in Laredo 4 years ago, when I moved here from the Pacific Northwest. So when people are like, these are high rates, I'm like, what are you talking about?
Yeah.
We're just not in a pandemic anymore.
Yeah.
So, thank goodness for that. But we're here to support you guys. We're thankful that you joined us on our live. If you guys were in there, please chime in, ask us questions, comment on what you would like to have answered on our next live, which is happening next Tuesday with Geraldine and I. So we will have, guest speakers like Gwen come over and say howdy to you guys and let you know about the process. I think next time it'll be just Geraldine and I, and after that we'll have an insurance agent talk to you about insurance, kind of like Gwen mentioned.
Yeah.
We don't want that roof to be excluded. So let's talk to somebody in the know and to let you know what we need to do next. We're signing off. Thank you guys.
Bye.
For joining us. Bye.